Imagine for a second that you had the power to transform something most people fear, interest rates, into a secret machine for multiplying wealth. While millions of people see high interest rates as an obstacle and low interest rates as a confusing opportunity, there is a small group that always finds a way to win, no matter which way the economy moves. These are the ultra-wealthy. And today, I am going to reveal how they turn the tides of global finance into a constant source of wealth. And more importantly, what you can learn and apply in your own financial journey. What you will discover here can forever change the way you see every single decision made by the Federal Reserve, the Bank of England, or even the European Central Bank. When interest rates rise sharply, the majority of people feel pain. Credit becomes more expensive, mortgages climb, small businesses struggle, and everyday life feels heavier. But the ultra-wealthy smile, because for them, high interest rates mean that fixed income assets, like government bonds, suddenly start paying absurdly high returns. Think back to the early 1980s in the United States. Inflation was rampant, and Paul Volcker, the Federal Reserve Chairman, pushed interest rates to historic highs. For the average citizen, it was devastating. Borrowing costs skyrocketed, unemployment climbed, and the economy slowed. But for the wealthy, it was an extraordinary opportunity. They locked in government bonds yielding more than 15% annually. Think about that. Money guaranteed by the government, growing safely, while the rest of the population struggled to survive. This was not just investing, it was strategic positioning. It was the ability to take a crisis that hurt millions and transform it into a foundation for generational wealth. And this is a pattern that repeats itself again and again through economic history. Now let's flip the board. What happens when interest rates drop to near zero? Most people think, great, cheap financing, time to buy my dream house. But the ultra-wealthy think differently. They see a world of cheap money as fuel to accumulate risk assets. That is exactly what happened after the financial crisis of 2008. While the world was still bleeding, central banks slashed rates and flooded the system with liquidity. The average family was focused on refinancing their mortgage or keeping their job. But billionaires and institutional investors were playing a very different game. They borrowed at nearly zero cost and used that cheap capital to buy entire companies, massive real estate portfolios, and even sports teams. And what happened a decade later? Those assets multiplied in value. The stock market boomed, real estate climbed, and private equity firms saw astronomical returns. While the middle class celebrated lower mortgage rates, the ultra-wealthy quietly reshaped their empires with assets that became far more valuable once the recovery was in full swing. This is their game. When interest rates are high, they lock in long-term fixed income with massive yields. When rates are low, they borrow aggressively to buy productive assets. It is not simple, but it is incredibly powerful. If this line of thinking is opening your mind, imagine what else you will discover here on Investor School. And since I am always revealing how the world of money truly works, make sure you subscribe right now so you never miss a chance to learn strategies that can transform your financial future. Here is something fascinating that few people realize. This cycle of adaptation to interest rates has been happening for centuries. In the 19th century, families like the Rothschilds prospered by financing governments during wars. When nations were desperate for cash, they paid extremely high interest rates on bonds, and these families locked in huge returns. Then, during the Reconstruction periods, when credit was cheap and abundant, the same families shifted gears and financed the building of railroads, banks, and entire industries. The same playbook appears again and again. Crisis brings high rates, and the elite use it to accumulate secure income streams. Recovery brings low rates, and the elite shift to buying and building assets that grow exponentially. It is almost like a choreographed dance, and those who understand it never look at central bank policy decisions the same way again. Now you might be wondering, all right, but I am not a billionaire. How does this apply to me? The truth is, you do not need billions to take advantage of this logic. You just need to think strategically. When interest rates are high, maybe it is your chance to capture solid, low-risk returns in fixed income products, bonds, or high-yield savings. And when interest rates are low, it could be the moment to consider long-term assets, stocks, real estate, or even building your own business. The key is to stop fighting the cycle and start surfing it. Most people react with fear. They freeze when rates rise and get euphoric when rates fall. The wealthy, on the other hand, anticipate. They adjust calmly, always staying one step ahead. If we zoom out through history, the pattern becomes crystal clear. In the post-World War II period, for instance, governments issued bonds at high yields to finance reconstruction. Wealthy investors who bought them locked in secure returns. But by the 1950s and 1960s, as global economies stabilized and credit became cheaper, these same investors poured capital into manufacturing, technology, and infrastructure projects that laid the foundation for the modern economy. Fast forward to the dot-com crash of the early 2000s. Rates were lowered to stimulate growth. Ordinary people focused on refinancing homes, but the ultra-wealthy began aggressively buying into technology companies and venture capital funds at bargain valuations. Many of those bets became today's household names in Silicon Valley. The lesson is not just about money, it is about perspective. While most people see interest rates as something far away, decided in some government office, the ultra-wealthy see them as signals. When the cost of money changes, strategies must change too. They adapt with discipline, and because of that, they always find a way to come out ahead. This means that the next time you hear that the Federal Reserve is raising or lowering rates, you should not simply think about how your credit card payments or mortgage will be affected. You should ask yourself, what opportunities are hidden here? What would the ultra-wealthy do in this exact moment? Because that question alone can shift your mindset from being reactive to being proactive. Interest rates are not just numbers on a financial report. They are the heartbeat of the global economy. They dictate how money flows, how businesses grow, how investments rise or fall. And if you learn to interpret this heartbeat like the ultra-wealthy, you will see opportunities that most people will never notice. So the next time rates go up, do not panic. Think about how you can lock in strong, safe returns. And when rates go down, do not just celebrate cheap loans. Ask how you can position yourself to acquire assets that will grow for decades to come. The ultra-wealthy do not celebrate or complain about interest rates. They simply adapt. That is the ultimate secret. And now the question is, will you continue to be part of the crowd that reacts emotionally to the headlines? Or will you begin to think like the ones who always find a way to prosper?